All right, so I got a good question on total return. And I think this is important because oftentimes you have people that think about the stock market or investing as growth only, that long term financial incentives. Or you have the other side of that bell curve where you have people that think about cash flow only, your bond buyers. So often stock equity buyers are more growth focused. We want the price to go up and then we'll sell it at some point. Um, they both have pros and cons. So if you're growth focused, you are more dependent on sell price. You are dependent on sell price. If you need capital, if you need your cash flow when the market's down, well, that hurts. If you need cash flow when the market's up, hey, that's great. We got extra, we can sell at a premium and pay taxes when we sell. So I want to think about it this way. Let's say we have a company called DVF, and that's not a stock symbol. Let's just think dividends. B is buybacks. So they're buying back shares on the open market. And then F is sort of future. So we're investing for the future. So if you have a company, and right now the average companies are at about 7%. Let's say you have a company, because DBF, theoretical company, is paying a 2% dividend. So of that 2% cash flows out to you. US stocks mostly pay quarterly, foreign stocks, usually it's twice a year. So it doesn't matter. Let's say 2% per year. Let's say corporate buybacks are 1%. And there's just recently been a new tax. When companies buy back their shares, they have to pay a 1% tax on their net buybacks. So the amount of shares they buy back minus the shares they issue or they give to their employees as stock options or restricted stock units, incentives. So that, of course, is 3%. So the extra 4% then goes to some sort of future. So the company is acquiring other businesses so that they grow that way. They invest in their employees so that they think they can make more money in the future. Maybe they pay down debt so that they save more. But that's a little more growthy. So how do we invest in new technologies? It might work, it might not. Those employees that you educate and develop might leave you. So, someone's always willing to pay more for someone else's employees than they seem to be willing to pay to retain their own employees. A lot of hiring bonuses, not a whole lot of retention bonuses until you get into the very top key employee tier. So, a company that's putting 4 other 7% to future is much growthier. That's more of a capital growth vehicle. Whereas, let's skew it. Let's say you have a company that's paying 7% out of dividends. So they're earning 7 and they're paying all of it out as cash. Well, that's a stock that's going to act more like a bond because there's not much growth there. You may be subject to inflation risk at that point because you're not keeping up with the markets. You're not keeping up with competitors. That's a cash flow investment. That's not going to be a rising income stream or anything like that. You need some sort of blend. And that's okay. You can have some companies and some pieces of your portfolio that are there to cash flow, particularly if you're retired. Cash flow is very important. Buybacks often come when there are a lot of depressed share prices. If the company's stock value is down and the company has a lot of cash, great time to do buybacks. Let's say you had theoretically 10 owners, and the economy is bad, so the stock is valued at 50 cents on the dollar. You could buy out one of those owners. Now the existing 9 owners get their profits. Let's say you have 10 owners and you have enough cash to buy out half the owners. So half the owners go away and they gave you their shares for 50 cents on the dollar. The remaining owners now get 100% of the profit. So they might be a little cash tied as a company, but suddenly they're cash flowing like crazy. So that would be a good buyback strategy. Whereas newer companies don't tend to pay dividends and they don't tend to do buybacks. If anything, they're issuing new shares to their employees, which dilutes. It's the opposite of a buyback. It dilutes ownership of who owns those shares. But they're growthier. They're excited. They think that dilution is going to be offset by future earnings and growth. Well, that can be very attractive for a long-term growth investor. Now, how you should be balanced is very custom to your financial plan. I like to think of everything sort of as a bell curve. If you're early in your career and you've got a long time before you need that investment back, you might be focused on companies that do that future. They want to grow. And then as a company matures, it does tend to head that way. Much like as we get older, we slow down and we're less experimental and we don't look forward as far. We tend to be wiser and safer. Companies are the same. You have startups doing crazy things, and the ones that make it become big companies. Bigger companies tend to be more regulated. They tend to be a little more cautious. They've got more to lose. And they do more buybacks to return that profit that they finally made to their shareholders. And they do more dividends. So that is sort of the total return of an investment. You have to look at all three. So how much is being paid in dividends? How many shares are being bought back? Is the ownership, are you diluting it? Are you concentrating profits? And how much of that profit is being invested for the future so that you get future growth?